Welcome. In your notes, you mentioned how gold prices have been supported by three risks. I want to get into each individually with you. First, you mentioned bigger budget deficits from the Biden administration's stimulus, expectations of more to come, and that's supporting prices.
Mm-hmm. Yeah, I think you heard from Fed Chair Powell yesterday that he expected to take the lead, that fiscal spending from the Biden administration will take the lead during this recovery. And when you look at the Biden administration, they believe that too little is a bigger problem than too much. And so you're going to see greater federal government stimulus through the next year to try to get our economy back on track again. This will result in bigger budget deficits, which are already at records. And so you're going to see increasing pressure on the dollar from this, and that's all good for gold.
Ed, talk to me about potential for, well, how low rates increase the risk of inflation. We heard from Fed Chair Jerome Powell yesterday also about, he was pretty clear that we'll know when it's coming, and it's nowhere near at that point yet. So, I mean, I imagine this is supporting prices as well.
Yeah, I mean, Fed rates, as you said, are between 0 and 0.25, so it's almost zero. That's very accommodative monetary policy. They are buying assets at roughly $120 billion a month. So when you add that up, that's printing a lot of money. You know, I was director of the Mint, and you know, when you see trillion, like $3 trillion so far of basically printed money, that increases the risk of inflation. And the key to watch here is not only the increase in the money supply, which we have, but also how quickly the economy recovers. If it recovers really slow, like the last time around, inflation will be controlled. But if it recovers quickly, like what some people think it's going to do, it's going to slingshot up because, you know, unlike structural problems that the last financial crisis had, the pandemic is a different kind of problem, and the potential for a really sharp growth that will give the Fed a lot of problems on how to sop up all this excess liquidity. And so I think that's where the big inflation risk is how the economy recovers. There's certainly a way oversupply of money in the system right now.
You know, on a quick note here, not necessarily related to inflation here in the U.S., but I just noticed German CPI at the top of the hour came out 1%, a little bit higher than prior, down 0.3%. They were looking for an increase of 0.7%. That's year over year, month over month, at up 0.8%, a little bit higher than their prior 0.5% increase as well. Now, you also mentioned how lower rates, in addition to lower rates, asset bubbles like the one that we're seeing in equity valuations also contribute to, again, what we're seeing in terms of, well, at least, very least, gold being supported, but ultimately, potentially for more bid to come there.
Yeah, well, you know, all that money has to go someplace, and it's ending up going a lot to equities. Yeah. And so there's a big fear that the equity valuations are way too high. And when that bubble pops, you're going to get a lot of volatility on the downside. And as a result, when that happens, people like safe haven assets that stay relatively, you know, out of the way, which gold is one of them. I think another bubble you're seeing out there is Bitcoin. You know, Bitcoin's had a huge jump. It's retracted maybe 10,000 from its 40,000 high. But still, that's another indication that there are a lot of bubbles out there that are just waiting to pop. And when that starts to happen, you're going to see a lot of people flee to gold.
Yeah, Bitcoin futures recently up to 42,730. Speaking of that flight to gold, you know, I was looking yesterday with the indices selling off. I was fully expecting to see gold on the move higher. It wasn't. Ed, why do you think? Is that a sign that investors just weren't that concerned about the magnitude of the selling yesterday? Or, I mean, your thoughts on that limited kind of migration to value or risk-off type assets that you'd expect to see migration into?
Yeah, so my interpretation is that's basically short-term volatility that is due mainly to the Biden stimulus plan being pushed off a while. Yeah, as you know, the administration proposed $1.9 trillion of new fiscal spending to try to stimulate the economy. But with the Senate receiving the articles of impeachment, once the Senate starts the trial, they can't do anything else until the trial's done. And so I think the markets are reading two fears into that. One is stimulus has been pushed off just because of politics. And number two is the appetite for $1.9 trillion, especially the increase to the minimum wage to $15, is beginning to wane, mainly because the Biden administration, to their credit, wants bipartisan support on this stimulus bill. And in order to get that, they have to cut that package down.
Yeah, you know, interestingly enough, too, and I want to get your thoughts on this as well, because it's all interrelated in terms of the stimulus measures, what we're hearing as far as expectations from the Biden administration and their efforts to provide infrastructure not only, but let's talk a little bit about the U.S. dollar, because if we could just pull these charts up, speaking to the fact that, well, gold's, kind of limited upside activity was maybe potentially influenced by some of the dollar. We certainly saw it get bid up. Maybe that's where some of that safe haven type migration went to. And there's clearly, you can see recently a direct correlation, somewhat inverse correlation with these two products.
Yep, absolutely. I think you've called that one right. I do think that, the fear is as you increase the money supply, that will push the dollar down. So the trigger will be with the stimulus plan being passed.
Lastly, Ed, in terms of what we're seeing into the new year, demand for physical, demand for ETFs, because that was a major driver in terms of what we were seeing into the 2100 highs back in August of last year.
Mm-hmm. Yeah, you're seeing more inflows into ETFs. And I think more importantly, you're seeing a bit of recovery in both India and China. Okay. So when you take a look at physical gold, there are a bunch of different markets for that, right? One is financial investors, which we've been talking about. But the other is retail. And so the retail sales are really driven by India and China. And with China's reporting a recovery, you're beginning to see increased sales on a retail basis. And once consumer sales of gold go up, you're going to see a tightening of supply, and that will also push gold prices up.